Richard, thank you very much. It's a great pleasure to be here. I assume that you can reasonably easily hear me sort of in the back rows. And I'm going to do something which is a bit of a sleight of hand, because I don't particularly want to talk about public policy very much, and certainly not about public policy vis-à-vis Islamic finance, because I'm not an expert. It would be preposterous for me to talk, particularly in front of some people in this room who I know very well are extremely distinguished scholars and practitioners of Islamic finance. So I want to range a little more widely over some issues that I think are of rising concern in society more generally, and to which I believe Islamic finance has an important set of messages and a debate in which I think Islamic finance can play a very important role. And you'll see what I mean as I get into this. But I begin with the obvious point that you will all be very familiar with. Islamic finance has come a long way in the last 20 years, and it's come a long way in this country in particular in the last 20 years. In fact, I remember a meeting that I went to with the then Governor of the Bank of England, Eddie George, who sadly died a few years ago. And this was a meeting that Iqbal Khan, sitting in the front row here, took me to, which was about Islamic finance and the reason why it was important to make some changes in British regulatory environment and tax policy to allow a sensible development of Islamic finance, because there was a growing demand for it. And I remember Eddie George telling the story of a young couple who had come to see him when he was still Governor of the Bank of England, or met him, I think, probably at some function, who'd said, look, they had got married, they wanted to buy a house, they were Muslims, obviously, and they wanted to buy it in an Islamically Sharia-compatible way, but the trouble was that the then stamp duty rules in the UK prevented an appropriate leaseback kind of structure, and they couldn't do it, couldn't do it except at a very considerable expense. And Eddie put his mind to working with the Treasury to get that rule changed, and that was the start, I think, of a process of public policy formation designed to ensure that Islamic finance could function properly within the overall financial markets of this country. There's a lot of technical detail behind that, but I think you would agree that we've come a long way since that period of, say, some 20 years ago. And one of the great milestones on this journey in this country was, of course, the issuance of the Government Sukuk not so very long ago, which was an extraordinary success, 10 times oversold. The demand was 10 times the supply, I should say. 37% of that went to the Middle East, and 17% of it went to Asia, and the rest basically went to banks in this country that wanted to build up their Islamic balance sheet. There are 6 Islamic banks in this country, and it was a great way for them to get some liquidity into their balance sheets. So by any standards, a roaring success, and I suspect not the last time that the British government will do it. And one thing is clear, that Islamic finance has become a part of the mainstream financial activity of this country, as of course it has in the Middle East and in Malaysia in particular, in Southeast Asia. Is this an industry or a financial stream that has come yet to global maturity? I'd say no. There's still some way to go. But then other kinds of markets have also not yet come to global maturity and have some way to go. When you think of venture capital, private equity, covered bonds and other kinds of more conventional techniques, I would say of them, they've got quite a long way to go to come to maturity. And so in saying that of Islamic finance, I'm simply recognising that it's still a remarkably young industry. It isn't for me to go into the detailed technical issues that still remain to be resolved on an international stage. So far as the UK is concerned, there is now, and this was set up by the current Chancellor of Exchequer, George Osborne, in my time as Trade Minister, and I had a little bit to do with getting this thing established, a thing called the Financial Services Trade and Investment Board, which covers a number of aspects of the financial services industry in this country, but one of whose half-dozen work streams is on Islamic finance. That board, based in the Treasury, has a former McKinsey director as its chair, and George Osborne, I know, turns up from time to time at its meetings. And it's doing things like looking at making UK Export Finance, the government credit agency, make available a guarantee facility for exports in Islamically, in Sharia compliant form. It's looking at what it means for the Bank of England to have a liquidity facility that's Sharia compliant, something which the Governor of the Bank of England has announced that they want to do with effect from next year. As in other markets, other financial markets, the technical detail is important, but it's technical and it's detailed, and to many of us it's frankly boring, but somebody's got to do it. And I don't want to focus on that this evening. Instead, I want to look at a wider issue which is of widespread and rising concern in society more generally, and not just in this country. It's an issue which at first brush appears to have nothing to do with Islamic finance. I hope to persuade you quite quickly that it absolutely does. And to which, as I said in my opening comments, I think Islamic finance can make an important contribution. In the wake of the financial crisis, there's been more and more attention paid to the problem in society at large of debt. There's a historical background to this, a deep historical background to this, and I believe that there's a very important perspective that Islamic finance theory can throw on it. Why has society become concerned about debt? Well, because in the wake of the financial crisis, there is now a huge overhang of debt, both in this country and in many other countries. It's an overhang which is graphically illustrated in the macroeconomic statistics of many countries, and these statistics I'm going to quote focus mainly on this country, but you'd see similar patterns elsewhere. When we went into the financial crisis, there was a government fiscal deficit in this country of 11%, which, by the way, was as big as the fiscal deficit of Greece at the time, which didn't feel like a comfortable space to be in. How do fiscal deficits get financed? They get financed by the issuance of debt. And so what you saw happen, no great surprise, is a quite sharp increase in the amount of British government debt issued, and the ratio of debt to GNP in this country shot up over just a few years from 40% to about 80%, where it now is. And that same steep rise has been visible if you look at that same ratio for other countries too. Japan, America, other European countries. Japan's ratio of government debt to GNP is now 240%. But it's not only government debt that looks like a huge overhang at the moment. Private sector debt, as a percentage of GNP, has also become very large. In the UK, private sector debt as a percentage of GDP, so private sector which includes corporate debt and individuals' personal debt, is now about 165% of GDP. That's actually down from its peak because the British household has been responding to the obvious pressures by actually reducing the amount of debt. Nevertheless, it's still 165% of GDP. In America, it's 198% GDP. Germany, 100%. France, 114%. And there are three facts that I think it's important to bear in mind about this. Firstly, it's almost impossible to imagine paying this debt down, which means it is going to be a constant burden on future generations. And secondly, that it cramps macroeconomic policy. If you think you have a slow-growing economy where the natural textbook thing to do is to try and stimulate demand through fiscal looseness, it's much more difficult to do that, or much more risky to do that, if you've already got very substantial levels of debt around in the economy. So it makes the obvious policy response to high levels of unemployment more difficult to use without undue risk. And then thirdly, if you worry about deflation in an economy, we don't worry particularly in this country, don't need to, but if you're in the continent, in the Eurozone, you absolutely should be worrying about deflation because it's quite close to being a reality. Deflation is a much more serious social threat if there's a lot of debt around in the economy, because it's easy to envisage what price declines do in a situation where people have got debt obligations that are fixed in nominal terms. The dislocating, destructive impact of deflation when there's debt, major amounts of debt around in the economy, are easy to imagine. This is largely, at the moment, a developed country phenomenon. Although there are earlier crises when it was a developing country phenomenon, famously the Asian crisis of the latter part of the 1990s, and earlier than that in places like Mexico and Brazil. But as of now, this is mainly a developed country, so Britain, America, the continentals, Japan. And if you take a longer term perspective and look at what's happened to debt in those societies, then an interesting pattern emerges. If you go back to 1950 and look what's happened to the ratio of debt to GNP in the developed countries over the time frame since then, you see that in the early period, in the 1950s, it was coming down. Because what had happened was that in the war, a lot of countries had built up very high levels of debt, basically to pay for the war. Britain had. And then in the 1950s, that debt got paid down, so the debt to GNP ratio was falling. And this was helped by the fact that there was a lot of economic growth around and energy was cheap. So not only was the numerator going down, but the denominator was going up very nicely, and so the burden of debt was receding as a problem in the British economy in the early decades after the war. That stopped in the 1970s, and partly because energy suddenly got much more expensive, and partly because growth slowed down, a related point of course, the debt to GNP ratio started to rise. And indeed, since then it's risen more or less continuously. In the early 1970s, debt to GNP in this country was 25%. Now, as I mentioned earlier, it's up to 80%. And similar trends are obvious in other countries. US, the equivalent figures, 50% in 1950, 180% now. The UK, for private sector debt, 1964, 15%, now over 100%, and so on. Did this matter? Well, theoretically, no, if the debt is taken on for productive purposes and if there's evidence of the economy in fact growing as a result of taking on this debt for productive purposes. But we all know what the truth actually was, namely that too much of this debt was taken on for consumption and not for productive purposes, and in any case the economies weren't growing. Instead what happened is banks got more and more leveraged, there was more and more instability in the system, risk perceptions are typically too low when there's a boom and too high when there's a bust, and so the system over-exaggerates in response, and macroeconomic policy options get more and more constrained. And then on top of all of that statistical stuff and macroeconomic policy stuff, you think of the individuals and the suffering that it poses when things go wrong and they're too overstretched in their debt. Famously, Charles Dickens, this is not a new problem, famously Charles Dickens in that novel Little Dorrit, which some here may have read, tells the story of what happens to a family that gets itself in too much debt, and it's a tragic story. Why am I going through all of this in a lecture on Islamic finance and to a group of people who are interested in Islamic finance? Because it leads me firstly into a bit of historical reflection on the role of debt in economies and some of the instincts that have been around as people have sought to deal with the risks of debt. And I will, I hope, show where I think that Islamic finance theory has got some very interesting perspectives that are of relevance to the whole of society in this. What is true to say is that for most of history there's been a real nervousness about debt. Treating debt as something that's benign, treating debt as something that's wholly admirable, which was probably true in the 80s and 90s, is actually an aberration. For most of human history, people have worried about debt. It isn't just Charles Dickens and Little Dorrit, and in fact you can go a long way back to find people worrying about debt, the role it plays and its consequences. And I go back for the moment just to two sources of worry. but they're just worth talking through because I think they're interesting. First of them is the ancient Greeks, specifically Aristotle, the great father in so many ways of European thought and philosophy. Aristotle, writing some 330 odd years before Christ, is the first well-known thinker to grapple with the issue of what money is and what debt does in a society. He argued that the only natural form of commerce, actually, was barter, because barter represented the quintessential example of two people exchanging goods because they wanted or needed the goods. And there was a profit, if you will, or a benefit on both sides. Actually, he thought that profit itself was a dubious concept. He felt that profit was adding something on top of the transaction that you had no real right to. And profit from lending money was completely unnatural. That's the word he used. It was unnatural. And indeed, he used the word of money. He said, money is barren. It is not productive. It doesn't do anything. And therefore, it's completely wrong for it to have any reward. He sort of mixed that up with the concept of profit, but nevertheless, the result was a view that transactions that involve money, and in particular transactions that involve lending and debt and interest, were at least unjust, and in fact, and this was a particularly damning word in his mind, unnatural. So that's one philosophical perspective, and it goes a long way back, on the risks and dangers of debt and money. The other one comes from in fact, an even earlier source, but a very different milieu, that is ancient Israel, which was, of course, an agricultural society. And here I'm going back 3,000 years to biblical times, where if you borrowed, you only borrowed because you had to. You borrowed because the harvest had failed and you had nothing to eat. And the risk was clear and stark. Those who borrowed, who became debtors therefore, ended up parting with their land. They ended up becoming tenants and eventually slaves. These social effects of this kind of borrowing, at least, were obviously damaging. And what is interesting about Israelite law, if you read the minutiae, which very few people do, in the early books of the Old Testament, is it was astonishingly, and for that time possibly even uniquely, concerned to ensure that the weaker were not exploited in this way by the more powerful. And so you get provisions that restricted land prices in sales of land as to not be more than a certain multiple of the number of harvests you could get to that from that land. That you could not use land as security for more than 7 years. And that every 49 years there was a so-called Jubilee period when all debts were forgiven. And you should pay wages promptly, because they recognised that paying wages in arrears is a form of borrowing without permission, as it were, for which you paid nothing and you exploited the person who is working for you. It's really quite interesting the way in which intricate detail was built in, the purpose of which was to protect the weaker, to protect the marginal, to protect the vulnerable. And there's a quotation, or two actually. First of all, and this clearly covered loans to the distressed, which was the typical pattern of lending, the book of Leviticus in the Old Testament. If your brother becomes impoverished and cannot support himself in the community, you will assist him as you would a stranger or a guest. Do not charge him interest on a loan, but fear God and let your brother live with you. Or, more generally, in Deuteronomy, both of these are some of the so-called law books of the Bible. Do not charge a fellow interest, whether on money or whether in money or in food. You may charge a foreigner interest, but not a member of the community. Now, this is 3,000 years ago. I don't know, I'm not an expert, I'm not sure whether there's anything in any other culture of that era that is of this quality, of this moral quality, if you will. The Bible, the Old Testament, consists of three kinds of books. Those law books, from which I've just quoted, history books, which tell you what happened, and the profits, which I'll come to. The history books tell you, amongst other things, that there's no evidence that these key principles were ever very systematically implemented. What they tell you is that by the time of King David, for instance, the land structure of the land must have looked a bit like medieval Europe. That is to say, it was owned by a smallish number of large families, large estates, on which most of the people in fact worked as either tenants or slaves. All of the abuses that you might expect from that were clearly around in the system. And it's that so often the prophets, who are the most remarkable parts of all of this, focus on. And in particular, one of them, not one of the best known ones, and certainly not one of the long ones, a very short book by a character about whom not much is known, called Amos, is vituperative in its attack on the expropriation, on the excessive wealth, the extravagant living, the brutalisation of the poor, and the hypocrisy of it all, because they turn up in the temple and do their ritual celebrations. It's a most remarkable, savage piece of rhetoric in the name of justice and fairness. So you've got these two strands, the Greeks and ancient Israel, feeding into a medieval European debate about the role of money and debt in society. And what were the attitudes then? Well, the Christian church at the time of medieval so before the Reformation, so this is 11th, 12th, 13th centuries, had strict usury laws, very strict usury laws. Sadly, one of the very unattractive aspects of life in medieval Europe was that because the Christians were not supposed to lend at interest, but there isn't anything saying they couldn't borrow, and because the Jews were banned from so many of the ordinary professions, but were allowed by their own code to lend to foreigners, what happened, happened. And it is one of the backgrounds to a rising level of anti-Semitism in Europe. But I don't want to dwell on that. What I want really to draw attention to is the way in which a Greek view of the, quotes, unnaturalness of money and debt came together with that Israelite view of the injustice and oppression that so easily goes with debt. These came together to create a very strong bias against borrowing at interest, lending at interest, strong usury laws. And to that was added a view of the so-called just price. If you were going to trade, there was a just price, a fair price. Labour, the reward for labour, but not more than that, was what you got if you sold something, and what you should expect to have to pay if you bought something. This was a long way from you can charge what you can get away with. There was a view that there was a just price for everything based on the reward for labour. All this began to change in around the 15th and 16th centuries in Europe. That coincided with the early beginnings of manufacture and the rise of cities. And the more that manufacture gained ground, the more there was a recognition of the role that money could play in investing, as opposed to just lending, helping people out with failed harvests and all the rest of it, but actually investing in enterprise. And so they began to think in terms of a return on capital. This wasn't interest on a loan, this is a return on capital. And that didn't seem so bad, because you were investing, you're putting your money at risk in a venture, you didn't know whether it was going to work or not, you know the arguments. And come along the Reformation, you get two of the big figures in the Reformation beginning to change the theory. First of all, Luther, but importantly, Calvin. Calvin, who's much the more radical of the two, looked at the economy, particularly of cities, and remember he was a Genevan, an urbanite, looked at the economy and said, these old usury laws aren't necessary. Because, firstly, there's a new overriding law which governs all human relations. That's the law of love. And if you act in accordance with the law of love, there can be no objection in principle to loans at reasonable rates between parties who have good reason to lend and to borrow. This is a big change, you can see. And I quote from the classic Calvin book which he wrote. And he's a brilliant man. Very lucid. If you read it now, you can see beautifully lucidly written. And one of the passages when he's talking about this issue of usury or not goes as follows. Usury is not now unlawful, he says. And remember, by this time he is in effect the kind of theocratic ruler of Geneva, except insofar as it contravenes equity and brotherly union. Let each place himself before God's judgment seat and not do to his neighbour what he would not have done to himself, from which a sure and infallible decision may be reached. Completely different sort of approach to the matter. A radical break with the past, but to be clear, a long way from recommending the free market. Luther was actually much more conservative than that. He kept to the usury laws, but he did start to see the value of investment and was certainly very conscious of the importance of what he called callings to different activities. So the craftsman becomes a respected figure in the Lutheran view of the world. But it's Calvin who is the radical. He talks about your responsibility under God to use the assets you've got productively for good purpose. This is, of course, not license to do whatever you want. That's very far from what Calvin meant. He was a very austere character. There wouldn't have been a lot of fun in the Geneva of his day. And there are plenty of passages where there's a strong censure of fraud, of extortion, of monopoly, all of those things. But the combination of a focus on what he said is the great summary law, the law of love, and the obligation of stewardship, created in many ways the basis for what you came to recognise in the 18th and 19th centuries as a new urban capitalism. Embodied at its best, and these have received a little more attention lately, more than they were due to receive more attention, the Quaker capitalists of the 19th century. At their best, these were people who looked after their workforce, who invested in businesses producing things that people wanted, who were modest in the way they lived, who reinvested rather than spent extravagantly on their own living standards, who gave away what they had accumulated at the point of death rather than handing it simply on to the family. So, for example, a niece of George Cadbury gave all of her wealth away to charitable causes. Bourneville, the famous Cadbury centre outside Birmingham, was built to provide a good living for the workforce and not just to exploit and maximise profits. And so successful was it that infant mortality had halved in Bourneville as compared with Birmingham, and so on. The truth is certainly more mixed than that. They didn't get everything right, and they didn't do everything the way you'd want it. Nevertheless, at their best, there was some remarkable evidences of good behaviour there. But of course, from the 18th century onwards, a process of secularisation is setting in Europe. And slowly but surely, the Christian underpinnings of all of this get cut away. And so you have philosophers from the 18th century replacing Calvin's law of love with a law of duty. Kant, in particular, great 18th century philosopher, argues for what he's called the categorical imperative, which is basically an obligation to do to others what you would expect them to do to you. So it's not an unreasonable thing at all, but it's taken away the connection with the responsibility of love. Secondly, and perhaps more important, the just price, which, by the way, survived all through Luther and Calvin. The just price, that medieval concept of the labour gets a legitimate reward, but there's no more than profit than that, gets replaced in the 18th century by the law of supply and demand. And then thirdly, and related to that, the role of competition as ensuring that supply and demand delivers a good deal, a fair deal. So Adam Smith, famously in The Wealth of Nations, written in the 18th century, "It is not from the benevolence of the butcher, brewer or baker that we expect our dinner, but from his regard to his own interest. We address ourselves not to their humanity, but to their self-love." The force of competition and supply and demand creating the output needed for people to buy their bread and eat. This is a long way from the medieval Christian view of things. It's a long way from Calvin too. The market moves from being a pariah to a panacea. Edmund Burke, the famous English political leader and philosopher, "The laws of commerce are the laws of nature, and therefore the laws of God." Literally, is what he said. And since then, we know what's happened. The market has become the supreme vehicle for allocating financial resources around the world. Not that these people were naive, to be clear. Adam Smith, the same person who said it, what I've just quoted, also has and as if this is a famous quote, "People of the same trade seldom meet together, even for merriment or diversion, but that the conversation ends in a conspiracy against the public or in some contrivance to raise prices." Perfectly well aware of the dangers of monopoly practices. Or Keynes, who said, "Speculators may do no harm as bubbles on a steady stream of enterprise, but the position is serious when enterprise becomes a bubble on a whirlpool of speculation." When the capital development of a country, he goes on, becomes dependent on the activities of a casino, the job is likely to be ill done. Yet, despite all of those kinds of reservations, and by the way, notwithstanding the fact that the 20th century saw the only great historical experiment that can count as an alternative to the market as an engine of economic and social development, namely Marxist communism, by the time you get to about 1990, you have reached what Francis Fukuyama famously called the end of history, namely the triumph of liberal market economics, and as he thought also the eventual triumph of liberal democracy. You also start to see in the 1990s ever more visibly the problem of debt. And it's in this context, against that wider background, that I want to look at the role that Islamic finance does and can play on the global stage. As I said right at the start, it's a young industry. Iqbal and I were talking in the car. I was sort of milking him for statistics. So in 1970, there were probably a negligible number of Islamic finance assets in the world. By 1980, $50 billion worth. By 1990, $100 billion worth. If these are wrong, blame him. By the year 2000, about $200 billion. And by the year 2014, $2 trillion. Which tells you, by my calculations, that the rate of acceleration is accelerating. Nevertheless, it's still 2% of total global financial assets, just to keep this all in perspective. But I would argue that this is, and potentially can be even more significantly, a real beacon of enlightenment in the context of the background that I've been talking about for the last 20 minutes or so. It's a real challenge to what you might call the market fundamentalism that has prevailed in the last 20 years or so, or let's say the 20 years up to 2007, because I think it started to change then. It's the voice of conscience, I would add, as far as Christians are concerned, who are involved in the markets, but who have forgotten what Calvin said, or ceased to apply it in any meaningful way. Islamic finance is evolving, of course, we would all recognise that. It's not perfect, because nothing that humans ever do is. But at its best, it is a carefully developed framework of rules whose core principle, is it not, is to ensure a human relationship of shared commitment and respect in any market transaction, any economic transaction. You know about the framework. You know about its applications in various sectors of economic activity. I am fascinated by, and I am not an expert, but I'm fascinated by the way Jara leasing techniques work, by the way, and forgive me if I pronounce this wrong, salam forward contracts, murabaha contracts between financiers and entrepreneurs, which allow for rewards to both for what they both bring to the party. We can see what the core principle behind all this is. Lots of work has been done in the last couple of decades, basically to allow the application of that core principle in a widening range of financial activity. Residential mortgages, where we started, commercial lending and borrowing and investment, equipment leasing, sovereign and corporate bonds, the sukuks that we also started by talking about, microfinance. I think that's interesting because of the power of microfinance in so many developing economies around the world. I personally have been involved in some microfinance businesses in different countries, Cambodia for one, and I was fascinated to read, again courtesy of Iqbal, about the Pakistani Akuwat microfinance business, which works on Islamic Sharia compliant principles. So it works basically on the zakat tax and the investment of that in the building up of the book. And just as is true in Cambodia, which is working on a conventional basis, the extraordinary performance of microfinance is there for all to see. 95% of the client base is women, empowering women in business. 99 point something or other % recovery of the loans. It's an extraordinarily powerful way of enabling the poorest, the most disadvantaged people to access modern standards of living, to access the mainstream of society, and to finance the things they really want to finance, which is usually their children's education. Extraordinarily powerful. And to see Islamic principles being applied to that in this particular Pakistani case is very moving and inspiring. I don't know where else that's true, but it's a remarkable example of what we mean by taking that core principle and applying it more and more broadly across the financial needs of any developing economy or society. I want to end on 3 points, really. One is that we're talking about an industry that's young. These are still early days. But the evidence so far is beginning to suggest that Islamic finance is actually more stable than conventional finance. The crisis may have exposed this. I think the absolutely honest truth is it's too soon to tell, but nonetheless it looks as though there's a greater stability, and it's sort of you'd expect it to be true given the risk sharing implicit in the principle. It's not, of course, been trouble-free. There have been incidents in Kuwait, in Saudi Arabia, the famous restructurings of Al-Saad and Al-Ghassabi, which, by the way, are a reminder that contracts do matter, that equal treatment before the law matters, and I don't think the record in either of those two cases is particularly brilliant. So there's plenty to learn. But overall, nonetheless, it looks as though the record of stability may be greater. To be absolutely honest, as I say, we probably need to wait another 20 years to be really sure of that. But the early signs are promising. That's my first point. The second point is that this is in another sense, this industry is still young. It's young in the sense that there is a structural imbalance still between the appetite to invest, the appetite to deposit, and the appetite to borrow, the appetite to use the funds for wealth creation. That means that pricing is probably not yet reached a stable equilibrium. And relative to commercial finance, yields are probably lower than they probably ought to be because of a surplus of appetite to invest compared with the opportunities to invest. I suspect that will cure itself gradually over time. You would expect it to gradually cure itself over time. And again, rather as my previous comment, you probably need another 20 years to wait and see how that pans out. My third point is that, and this is really the point I want to end on, now is the time, I think, to participate very proactively in what is becoming a great debate with a capital G and D almost about finance and the way it works, about the role of debt in society, about economic and social development and the financing thereof. As you will, I suspect many of you will be aware, a book was published earlier this year by a French economist, which argued that there's a structural tendency for the financial system to create greater and greater inequality, both of wealth and of income. I don't know whether anybody's actually read the book. Has anybody bought the book and read Piketty? It's the Piketty book. It's called Capital, written by a French economist who nobody had ever heard of until the book was published. And I don't know whether anybody's read it. It's 800 pages long. It's full of quite a lot of arithmetic and algebra. And the easier way is actually to read the reviews of it, which is what I've done. The fact that that became a bestseller, the fact that a long technical book by a relatively unknown French economist became an international bestseller, tells you that society is very worried now about the way in which the economy and the financial system are developing. And this is about debt, for sure, and it's about inequality. I think that there's a real role for scholars of Islamic finance to play in the debate about this, because, as I suggested earlier, there's a real sense in which so much of what Islamic finance is seeking to achieve is a lesson for everybody and a beacon of enlightenment. You have to be careful about that involvement, of course, because it's also challenging, because we also know that none of us is perfect. And if challenged, for example, on the issues of equality or inequality, if challenged on how many people actually pay zakat tax, for instance, if challenged on what has been the trend of giving under that principle, I don't know how many countries would score and how many individuals would score. Any more than I know, or rather I think I do know, how many Christians would score against the requirement for tithing of income. I rather suspect that they wouldn't score very well. But the point is that in so many ways there is so much proximity of basic intent between, say, Calvin and the core principles of Islamic finance, that to explore this in a great debate about the ills that we know are around in modern society would, I think, be an extraordinary opportunity. I don't know how much of it happens. I was talking again with Iqbal in the car on the way up, and he says there is some of it. I suspect that it would be good for everybody if there was more of it. That debate on finance in the wake of the crisis is now vibrant and active and live. As recently as this morning, I was in the City of London talking with a group of people about ethics and value, the relationship between value, and they meant shareholder value, and values in this more complicated age that we now live in. Part of that debate is about the way debt works and the way in which you should have people relate in financial transactions. And on that subject, it is very clear that Islamic finance, the theory of Islamic finance, has a great deal authoritative and important to say. Thank you.